Hi, welcome to Think Beyond the Keys. I am Melvina Fredson-Cole. I'm your host today. I have to apologize. We had some technical difficulties going on live on Facebook. So that is why you're listening and watching a recording. So I apologize for that. I am super excited. We've been hearing about refinancing. And today I have our own in-house TJ Roberts. TJ, thank you for coming. If you've been listening to this, TJ was on before regarding first-time buyers and the mortgage process. Now she's back. TJ is with Paramount Residential Mortgage Group, and she has been in the field for over 35 years. And what's cool about TJ is that she began on the underwriting risk analysis aspect of the business. So that's how she got in. And so she has a unique perspective, which is really important, especially during these times that we have her with us on the retail side also now. So I'm excited. So welcome, TJ.
Thank you so much, Melvina. Thanks for having me.
Okay, I'm going to dive into it. Now,
go for it.
TJ, what is refinancing?
You know, that's a really good question. A lot of people who have not refinanced their home in 10 to 12 years. And so knowing that they may never have refinanced, it's a good question to ask. Refinancing is when you structure the debt that you currently have against your home by either lowering the interest rate or getting cash out and lowering other debts that you have. So refinancing is a refinance of the debt that you occurred originally, or incurring new debt onto the mortgage that makes your cash flow and your financial picture better.
Awesome. So you said, so just like you said, the reasons to refinance, especially now, right?
Yes.
What's happening now?
So right now, interest rates are at an all-time low. I'm sure that you've heard that they're at zero. No, they are not quite at zero, but interest rates are at an all-time low, and we're seeing conforming loans under $510,000 getting rates in the twos. Which, you know, I've been doing this a long time, 35 plus years. I have never seen interest rates this low, and so a lot of people are taking advantage and being able to lower their monthly outgo, be able to have a little bit more cash in their bank account. Savings rates are up because people are refinancing and they can put some more money away, either for retirement or just not be living paycheck to paycheck. So yes, the refinancing is here to stay because of interest rates. But not only that, you know, tapping into some of the equity in your home for your kids going to college or for buying that second home or that retirement place. You know, we're seeing a lot more of that, maybe paying off all of the debt that you have so that you have a one low payment for everything. We're seeing a lot of that in the refinance world right now.
One thing that as a realtor, I think that this may be beneficial, correct me if I'm wrong, coming from a realtor perspective. We see a lot of homes when they're ready to be put on sale that they're a little bit outdated or they need an upgrade. And because of that, you know, there's a lot of deferred maintenance.
Mm-hmm.
And because of that, unfortunately, it's heartbreaking to see that some homes cannot be sold to the max that it should be because of that. So do you think this is a wise time for people to do some minor, that they don't have to be elaborate, but some minor upgrades so they can keep ahead or keep in line with the value of their home and match the value of what's out there, right?
Well, absolutely. Buyers still want to have a pretty turnkey property. Doing a new first mortgage to get cash out to have a property that's going to be sold in a very short term doesn't seem to make a lot of sense for a few reasons. Normally, when you are doing a mortgage, they're going to have you sign a document that you intend to occupy that for 6 months. And if you know that you're going to be selling it within the next 6 months, then you're going to be saying something that isn't true. However, I would highly recommend doing a credit line that you can secure against the property, helps you with your capital gains for any type of profit that you have in the property, using the money from the property itself, the equity to track what you're doing for those home improvements, whether it's putting in a new kitchen or new flooring or just having the whole place painted. Whatever it is, using a home equity line as a second mortgage to get you ready for the market to get top dollar is a smart use of your asset.
Okay. What about people who are in their home? They don't want to sell, but they know that, oh, those cupboards are really broken down. They need to change their floors. Maybe their carpet are all worn out, and it's a lot to change the whole home. And they have no interest in selling. They just need to just change these little things and maybe do the roof. Is it better to just do a refinance, or do they also have to do the equity line of credit?
I would recommend if somebody is going to stay in the home, the interest rates are so very low for a fixed 30-year fixed mortgage, or even if you want to do a shorter term mortgage, they're so low. I would do a first mortgage and get the cash out to do those improvements or those future improvements, or to sock that money away for reserve. It's a very smart use of your money and your equity, especially because cash flow wise, it makes sense. Instead of doing a loan for flooring or a loan for some type of construction or any type of upgrades, you're going to have that included in your mortgage, and therefore it's going to be at the lowest possible interest rate. So it is a great idea to be able to refinance and improve your property, especially in this shelter-in-place world that we're in right now. We're seeing a lot of people want to do a cash-out refinance to make their cash flow better, smoother. They don't have other debts, and maybe they want to put a home gym because they can't go to the gym anymore. Maybe they need to have a designated office for both the husband and the wife, or for both partners in the relationship. And on top of that, maybe they want to have a designated school area for their kids. And so we're starting to see a little bit of that shift of that, oh, we all want open concept, and now we're all saying, oh, we want walls to wall in our family.
Yeah.
So yes, it's a great opportunity for us to take advantage of the equity that we've gained in our homes and put it back into the home and make it available when we do want to resell, but also have it function for us today. A lot of people are discovering that they really need to have that function today in this, non-commuting world. We're not commuting like we used to. It's the commute from the living room to the office and the back of the house or the corner that you have to do your work in. So that is one way that people are refinancing.
Now, speaking about low interest rates and everything else, something was announced today, actually, and it's from FHFA. What is all that about, and how does it impact people that are already in the middle of refinancing?
Sorry.
No problem.
Okay, so if they're in the middle of refinancing, this can be a problem. FHFA came out with an announcement today that they are, and for those of you who don't know who they are, they're the ones who run Fannie and Freddie. And so they're all of your loans under that 756 in the high balance counties, or under 510,000 in the rest of the U.S. So what they came up with is a 50 basis point increase if you're penalty, basically, if you're doing a refinance. Okay, rates are very, very low. What is 50 basis points? Well, 50 basis points is 0.5% in fee. So based on your loan amount times 0.50%, that would be it. Most people know points in points, so 1%. 1 point. This is 50 basis points, or 0.5% increase, just because it's a refinance. So right off the board, that's one of the things that's going to impact people who are waiting in line, which is kind of what's going on with as much volume as going on right now. They're waiting in line to get their refinance and get that nice low rate, and they're being very patient about it. But Fannie Mae and Freddie Mac decided, we're going to add this little additional way to make money for us, and that's what it's doing. And it's going to go straight to the consumers. It's not going to impact the banks because it's a cost from Fannie Mae, but it is going to impact the consumers. And I think it's kind of a disservice. but I don't have any control of it. And unfortunately, hopefully, write to your people about FHFA and tell them what you think, because this is the opportunity. Rates are low to stimulate the economy, to get more dollars into the economy. And if you make it cost more to refinance, that less people can do it, then you're not going to get that money into the economy. You're not going to have that savings into the economy, and it could stall a lot of people. If you're in the process of refinancing, and if you haven't locked in your rate, which I don't know if you know what locked in is, but if you haven't had a rate commitment for you, then this half a point will be in your locked loan when you go locking forward. So if you're locked now, you should be pretty good as long as you can close on time. But that's kind of where it stands. It's not a great announcement. We've had a few toughed up announcements lately. So
I have so many questions from what you just said, but I just want to take it back. Because people are listening, and I just want you just to clarify a little bit, like basic level. What is Fannie Mae, Freddie Mac? How do they play into the mortgage? Why are they so important? And if you can just clarify that before I get to my next question. Yeah,
so Fannie and Freddie are the main source of mortgage-backed securities. They're the ones who write the conduit for the guidelines that we adhere to for what is and isn't a good risk. And so they are the backbone of the industry at this time. Currently, they're a quasi-government agency. They used to be independent, but after the mortgage meltdown, they were taken over by the government, and they were supposed to be independent by now, but they haven't become independent. So the FHFA has made some announcements that have impacted the ability for people to buy right now during COVID times, and it has impacted the ability for people to refinance and lower their debt. And some of it makes sense from the risk side, some of it doesn't.
Okay, thank you. Thank you for clarifying that. So basically, Fannie Mae and Freddie Mac, they call the shots simply because they buy the loans so that lenders have more money to lend out, basically. So,
and with the gold, make the rules, right?
Yep, that's the goal, make the rules. So if I'm happy, I'm like, okay, I had like a 4 something or a 5 something refi. Now I can refinance to like 3.5 or 3.4. So does that mean that, let me just take 3.4. Does that mean that now my rate will go 3.4 to 5? How would that affect a 3.4?
I don't understand the question, but if you're dropping your interest rate, most of the clients I'm seeing right now who are just dropping their interest rate are going from anywhere from 3.875 at the low side to maybe 4.5. And they're coming from that side and they're going down to 2.875, 2 5/8, which is 2.625 in interest rate. And when the thing that people don't realize, even though that's a dramatic drop in rate, we used to say if you could drop your rate a 0.5 point and you weren't out a lot of money, then it made a lot of sense to do that. Now you're kind of looking at 7/8 to 1 point for it to make sense. Because of the fact the interest rate is so low, it's such a small amount of your payment. So one of the things we talked about before was if your interest rate is historically at what it's been for the last 30 years on average, which is 7.5, you're not going to be paying much principal. You'll be paying mainly interest for about the first 5 to 6 years. When you have interest rates in the 2s and 3s, you're looking at paying a big chunk of principal right off the bat. Even the difference between a 3.5 and a 2.5, dramatic amount of interest savings. And that's where you get the benefit in the long run. Even if the payment isn't dramatically changing, you're saving and you're paying more principal right off the bat and less interest, which is, good.
Awesome. Thank you. And I just want to circle back to something you said about lock rate. Can you explain to someone who is refinancing for the first time, and then they start hearing that, it's like, what? Should I lock rate? Should not? Well, what is it?
So locking in a rate is a rate commitment that you have between you and your lender. They securitize that rate that you lock in, and they're committed to deliver a loan at that rate. So you have a book of coupons running from, we're just going to pick some numbers, from 3.25 to 2.5. And all of those prices have either a fee or a discount, a credit involved. So the way I always try to explain it to my consumers is interest rates, the lower the interest rate, the higher the cost. The higher the interest rate, the lower the cost. Well, the benefit is the lower the interest rate, the lower the interest. So if you can have a low interest rate near par, meaning that's what the window rate is delivering. Let's say it's 2.625 is the window rate. That the coupons on either side of that rate either cost you money or get a credit for it. So if 2.625 is the par or the zero rate, and you go up to 3%, they're going to give you a credit to pay some of your costs associated. And that credit can be paying your costs. And that credit means you basically are getting some of that interest refunded because they're expecting you to pay at that 3% for a minimum of 3 years, 2 years, something like that. And so they're giving you an advance back on you paying a higher than market rate interest. I'm not a huge fan of rebate pricing just because with interest rates this low, I want you to take advantage and have the best possible rate for your cash flow.
Yeah.
So we look at all of them and we always let the consumer choose. Yeah. Just by the same token, if you can buy, if the window rate's 2.625, but you can get 2.375, which is a quarter lower, probably not a huge difference in payment because it's not a huge, amount of interest. But if you can get it for a cost that is going to be able to be saved in 2 to 3 years, then it makes sense because chances are at that rate, you're not going to have to pay title and escrow fees again and go through the process again, unless you want to do a home equity line or, that type of thing. So I always give those choices to my clients so you can look at all of them. So
basically like these loans, buying, refinancing means that it's a commodity. You go in and said, I want to refinance. And you said, like you're going shopping for a car or a home. And then each of the products have price tags. And each of them have advantages and disadvantages, and everything is unique to that person's situation. Are they going to stay in the home long? Are they going to do that for different things? And then between you and your lender, you discuss that, and then you lock in your rate. So when you lock in your rate, from what I understand, it means that it doesn't matter if the rate goes up or down. That's that package is what you get, right?
Correct. So if you locked in your rates yesterday before the half a point came in, that is the rate that you're going to have. That is a locked commitment for you, even though technically when that loan is delivered to Fannie and Freddie, we're going to be charged, the lender is going to be charged that half a point because they made it immediate. So it's one of those things where we're going to take the initial hit, but the consumer in the long run is the one who's going to be taking the hit for that because it's going to be more expensive for them to be able to get a lower payment, a lower interest rate, and have the benefit. So a locked-in rate, there are lock-in periods, 21, 30, 60, 90, 120. You don't see too many people doing the super long locks. With the market like it has been, I've been locking a lot of consumers at 45 days just to make sure we had enough time to close. When we lock in for that 45 days, we also have the ability to renegotiate. So quite a few of the people who locked in 2 or 3 weeks ago, we're now getting ready to close and rates have come down. So we're able to renegotiate to a current market rate, split the difference kind of thing, and give them the benefit. Anytime you can give the consumer an additional benefit before you close, you want to do that.
Absolutely. That's great. So now I know some people who refinance, some of them have had their mortgages for a while. So they've gone through the process of getting a loan. So my question is, my question is, how can, what do they need the same paperwork? Do they have to have appraisals? Do they have to go through the whole process just like the first mortgage?
So basically when you do your purchase transaction, your paperwork is quite a bit different. You have a lot of things that you're reviewing about the property itself, a lot of things that have nothing to do with the loan itself. When you're refinancing, it's usually a bit more streamlined process. You're going to need we lost you. We're going to need your income. We're going to need maybe not even need your assets if we don't need any money to close. And we're going to need income for the last 2 years. The thing that you will probably not need an appraisal on most loans under 750 if they have any good SSRs or any good data on what values are in the area for Fannie and Freddie. So oftentimes we will.
I lost you, you froze. You froze. Okay, TJ froze. I'm going to speak until we get back to her. Yes, there's some paperwork.
Prepaid interest.
Oh, you froze. Can you just repeat that? You froze for a while.
Oh, you were frozen the whole time. I had your picture up on the screen, and I was talking away.
Oh my goodness! I know I couldn't hear you on my end, so so just a quick thing. So sometimes you may need appraisal, or you may not need appraisal.
So yes, that's absolutely true. If Fannie Mae and Freddie Mac have an established value for your property and it's within that range, they will come back and give us a PIW, which is appraisal waiver. And oftentimes you don't need an appraisal on a refinance. And of course, if you're doing a government loan, streamlined VA or FHA, no appraisal is required for that.
Awesome.
You are required to provide all of your income documentations. We still have to have the ability to repay. So the two big things when you're looking at refinancing right now that are hard and fast with everyone, all of the lenders, is one, you need to be paying the bills you currently have. So if you have any accounts in forbearance, you are not currently eligible for a refinance with Fannie or Freddie. You need to make sure those accounts have been pulled out of forbearance and have been paid. If you needed to take forbearance, then you need to use forbearance and move forward and take the next steps, which I'm sure we'll have a meeting about that in one of these and talk about what happens if you get into trouble because of what's happened to the economy with COVID. And then the other piece that you have to look at is, okay, so I don't have anything in forbearance, but I don't have any income. So that's a real problem. FHFA came up with a guideline, Fannie and Freddie came up with it separately, so it's combined, the two of them, but they came up with a guideline that really hurts the consumers who are hourly right now. And if you are working in a field that was shelter in place, shut down as of March 16th, and then they didn't reopen until, let's say, June 16th, you had 3 months with no income. This really hurts people in the trades. This hurts people who are maybe per diem because of the fact that they have to take that 3-month gap and put it in their year-to-date income. So they lose about a quarter of their income. And the reason why that was initiated on July 1st was because of the fact that the shelter in place was not lifted like they had forecast. And Fannie and Freddie on the conservative side are saying, well, what happens if you have another 3 months where you have to not work? And we don't want to grant additional debt to people who aren't paying their current debts. And we don't want to grant additional debt or a loan to somebody who can't pay their bills. I mean, those are two real logical core pieces that are impacting our consumers right now. Those are not the paths for a refinance. A refinance is for somebody who says, hey, I want to get ahead. Things are going well. I can make all my bills, but I'd like to be able to save a little bit of money, put a little money aside and move forward. That'd be a little bit better.
Thank you, TJ. Wow, that's a lot. Thank you. How many times can a person refinance?
Well, that's actually kind of a funny question. So, us lenders, really, when you refinance, we want minimally for you to make 6 months mortgage payments under the new refinance. There are some government programs where you can't refinance before that under the streamlined programs, but Fannie and Freddie do not regulate that. We, as lenders, we want you to make at least 6 payments. So could you refinance twice in a year? Yes. Do you really want to? Probably not. I have buyers, I have people who I help buy, and I have refinanced 3 times in the last 4 years, just because the interest rates and the trends benefited them. They needed additional cash out. There were things that were going on, and it made sense for them, and their payments gotten lower every time. But it's not going to always be that type of market. And I wouldn't refinance now if I was a consumer and do the effort only to have to refinance again in 3 months.
That's not sense.
Logical. So yes, a minimum of 6 months mortgage payments on your new loan. Years even better. They are talking about Fannie and Freddie having a early payoff policy if they pay off in the first 2 years. Well, it'll be very hard to lend if that's the case, because it doesn't hit the penalty for the consumer, it hits the penalty for the lender. So if they know there's going to be a penalty hanging out there, they may not want to lend because of the risk. So
wow.
I'll keep you informed as those things change.
I think, yeah, we'll be doing like a monthly update on what's going on in the mortgage world, because that's really important. I think we should be doing that. So one last question.
Okay, give me a good one.
Or two more. One is, some people are asking, why is my refinancing taking so long? And number two, what out of the pocket upfront cost is someone required to pay upfront, and it's not
okay? So what do you pay out of pocket on a refinance if an appraisal is required? Most lenders require the borrower to pay for the appraisal. It is their appraisal, and that's the reason why. Good to know, if you do need an appraisal on a Fannie or Freddie loan, those appraisals are portable. So if you started with ABC Mortgage and you end up with PRMG Mortgage, oftentimes if you needed an appraisal and for some reason the other lender couldn't do it, you can transfer the appraisal over and you won't have to get a new one within a certain amount of time. So that is a benefit. And that's the same thing with VA and FHA, but that's standard across the board. So that's the only real upfront cost. The other costs, the lenders themselves incur. We incur costs by doing processing, by spending hours on the file, and by ordering your credit report when you authorize it. And those are kind of our out-of-pocket expenses. When we close, we'll get reimbursed for those, at least a little bit. For us, the processing fee is $4.95, which is not very much money to chase all the paperwork. And then we disclose on a couple credit to be $100, but we only charge what it really costs. So the credit maybe costs $34, and then that's all you pay. You never pay more than the actual cost. There's no profit center in there. On a credit report, if for some reason we have to go and help you fix things that were reported in error that you have proof, and we have to order additional reports and it ends up costing us $120, well, you can never pay more than $100 if that's what we've disclosed. So, those are the kind of things that are in for protections for you. So the upfront cost really would only be an appraisal. There are some lenders who require you to pay your own credit report. There are some lenders who require you to pay an application fee right up front before they'll even underwrite your file. So we don't, but there are companies that do that as well.
Oh, that's kind of cool.
So you want to know too, upfront and out of pocket?
Yeah, I just want to know, like, just to let people know why the process is taking longer than usual now. Just like to let them know. Just
the sheer volume of business. We did over $1.5 billion last month. And that's just an incredible amount of business to be going through. It's just the volume. It doesn't mean there's anything wrong with the quality. Now, I've been doing this a long time. When I was an underwriter, we can underwrite 8 to 10 files a day. Wow. Not a problem. But now you're lucky if you can do 2, and you're a good underwriter if you can do 2.5. The reason why is the underwriting has been charged with double and triple checking everything about that file. And it's really because of the mortgage meltdown. There's triple checks and double checks of everything you can imagine, and then some. And all of those pieces have to be there to make sure that it's a good risk, and make sure that it isn't identity theft, and make sure there isn't appraisal fraud. All of those things to ultimately protect the consumer. That's one of the reasons it takes so long. Well, thank you for your time. I mean, that's a lot of information. And I know, I would encourage you, if you're watching this, share with others, and ask me questions. If there's something that's not clear, just DM me, and then TJ will get back to you, send your information, because one of our goals, both TJ and I, is just to make sure that you're informed and knowledgeable consumer. And so when you make decisions, you know why you're making it, and it'll benefit you and your family. So thank you, TJ, so much for your time. I appreciate you. And we'll be doing this again, because there's so much to learn, I know, and people have that. So I'm going to make this like a month, make sure we talk about mortgages some form or other every single month. So thank you. Thank you out there, guys. Thank you for watching. And this is Think Beyond the Keys. And we'll catch you next week. Oh, next week, you have to be here, because I have
a special attorney coming in just to speak about probate, trust, wills, and conservatorship. So everyone with a home, without a home, because millennials, guess what? There's a transfer of wealth. You need to know these and tell your parents or grandparents and help them out
Yeah.
in this area. So have an amazing week, and I'll see you next week. Take care.